Hello everyone and welcome to our UK election webinar. My name is Craig Erlam, Senior Market Analyst at OANDA. Thank you for joining us for another one of our webinars. This one of course is focused on tomorrow's UK election. And of course it's going to be a big event for the UK. I think it's going to be a big event for the markets as well. There's going to be a big focus of course on the UK currency, the pound. There's obviously going to be a big focus on the FTSE as well for a number of reasons. Of course, there's the UK, there's the pound linked to it and the inverse correlation that we've seen. But of course, depending on the result, the FTSE could respond in a number of ways. Now, firstly, I just want to take you through a few of the key details surrounding the election. First and foremost, actually, if you've got any questions, please do ask. I will try and answer all questions either during or after the webinar, sorry. But firstly, talking about the election itself. Now, a few things to note. The polling will take place between 7 a.m. and 10 p.m. UK time. That's BST or GMT +1. During that time, the UK people will be casting their votes. We will not hear from, there'll be no more campaigning, and there'll also be no exit polls. The exit polls will be released at 10 p.m. Now, the difference between the exit polls and the general polls is that the exit polls is based on how people have said they have already voted, as opposed to ordinary polls that tell you people's voting intentions. And again, people aren't always being honest. It depends who is being asked the question, who's filled out the polls, and a number of other things as well. So that's why we get a variety in the polls. But the exit polls tend to give us quite an accurate idea of how the electorate has actually voted. Now, while I've just said that, I am going to bring up something here. This is on the FT website. It's called the Poll of Polls, or the Poll Tracker. Now, what this does is it follows a number of different polls that are generated over the course of a number of time. You can see a lot more here, but these come from the likes of YouGov, from Opinion, from ICM, and there's a number of others, Ipsos Mori, a number of other poll collectors do contribute to this, and it shows us over time how people's polling numbers have performed, and this is one of the reasons why there's been some uncertainty in the markets. Now, I know what you're probably thinking. I remember the polls from 2015. I remember the polls from Brexit. I remember the polls from the US. They were wrong. They were wrong all the time. The markets reacted very strongly to them, particularly with regards to the 2015 general election in the UK, and ultimately they were wrong. And while that is true, there is very little else to go off. You'll remember that during the Brexit debacle of 2016, people started following the betting odds, and it appears that they have been manipulated, and the markets followed suit. So the result was actually far more in line with the polls than it was with the betting odds, even if previous elections had followed the betting odds. So I think people are paying a little bit more attention, not overly so, but a little bit more attention to the polls on this occasion. And what do the polls tell us? Well, the polls tell us quite simply that the gap between the Conservatives and Labour has shortened considerably. You'll see that when May called the election, the Conservatives were viewed in many polls to be 20 points or more in the lead. This was giving them a considerable majority of way more than 100 seats. And I think that was clearly one of the reasons why May called the election, to get that strong majority ahead of these Brexit negotiations, to get that considerable backing for these negotiations, and probably to give herself a little bit of legroom in the negotiations, with them currently concluding in 2019, and the next election was scheduled for 2020. Well, this will put that back by 2 years and just give it that little bit of extra legroom. And I think she ultimately wanted to take advantage of this massive void. Now, the problem being that since the election was called, Labour has closed the gap quite considerably, or so the polls would have us believe, and now the margin that we now find ourselves in has created this element of election uncertainty. And I think that's why, as you'll see in a second, the pound has pulled off slightly. The FTSE seems to have stabilised somewhat. We haven't seen it pushing on to new record highs, and I think people are in this phase, it's this period of caution where people don't want to necessarily move too much in either direction. We've had that initial response to the polls, but now it seems that this week it has been a little bit calm and a little bit of wait and see mode. And I think once we start to get those first exit polls, then I think things will certainly liven up again. Now, in terms of what the possible outcomes that we could have for this for this election? Well, of course, the most likely outcome at the moment is still a Conservative majority. Now, I think this would probably be, at this stage, the most market-friendly for a couple of reasons. One, it offers the continuity. We've got a Conservative majority at the moment, and therefore we know that 1 week later, maybe 7 or 8, 9 days later, when the negotiations are set to begin with the EU, we know what their stance is, we know what they're planning to do, and they know as well. So it means that negotiations can get underway. And when they're already 3 months delayed because of this election and because of other elections in Europe as well, I think that is generally seen by the markets as positive. Another possibility, of course, is a Labour victory. Now, that would be one of the biggest surprises because the size of the gap heading into the actual when the election was called. But even now, the gap at 6 or 7 points on average. Some would suggest more, some would suggest less, but 6 or 7 points on average. That is a huge gap to overcome now between now and tomorrow's voting, and I think that would therefore be one of the biggest shocks that you could possibly expect. And I think depending on who you talk to, the reaction in the markets could be very different indeed. I think for one, it would offer a little bit of uncertainty in terms of the Brexit negotiation stance, so that could potentially be seen as negative for the pound. A lot of people have questioned the fiscal integrity of the Labour plans, so potentially that could weigh on the pound as well. But I guess the flip side of that is they've promised to spend. They want to do more infrastructure spending. They want to spend more on the NHS, etc., etc. Now, while we thought this was initially going to be negative when Donald Trump was elected, the markets did have that knee-jerk sell-off reaction, but then they rallied because ultimately people believing that at least in the interim, or at least in the short and medium term, this extra spending is positive for the economy, and this economic boost is good for economic growth. The other thing it's good for is inflation. The more you spend, the more inflation you tend to generate. And if you're expecting inflation to tick higher, then that would suggest that we're expecting interest rates to raise in response at an earlier date. That should also, you'd think, logically be positive for the currency. Also, if you're going to issue more debt in order to pay for this spending, then that would suggest that gilt yields will have to rise because prices will fall. And again, higher rates tend to be positive for the currency. Now, what I'm trying to get at here is it's not a straightforward thing. Sometimes we'll look at these things and we'll say, here's your straightforward outcome to this. What we learned with Brexit was there is no straightforward outcome. When Brexit happened, the pound sold off around 10%. When the FTSE also sold off around 8%. What happened 2 days later? Well, the pound stayed where it was. The FTSE actually rallied back and within a few days was back above where it started because the weaker pound was viewed as being beneficial for the index. These choppy whipsaws can happen around these elections, especially when you get these uncertain outcomes. So, while there could be disagreements about how beneficial Jeremy Corbyn and his party could be for the pound itself, I think initially, the surprise factor could potentially, again, this is purely guesswork, but it could potentially be weak for the pound and weak for the FTSE, and then we'd have to see how they respond afterwards. For me, I think the worst results as far as the market is concerned would be the hung parliament. The simple reason being that the hung parliament creates more uncertainty and for a more prolonged period. A hung parliament means that we need to see negotiations between parties to form a possible coalition government. It leaves open the possibility of no coalition government being agreed and therefore further elections having to be held. And at a time when we're already on a time scale, when the UK has 2 years to negotiate, or 1 year and 9 months to negotiate its exit from the EU, this has to be seen as the most undesirable outcome by the markets. It creates more uncertainty, and ultimately markets hate uncertainty, and I think this would be the thing that would be worst for the pound and probably worst for the FTSE in the short term at least. Again, that is my personal opinion. But I think at least in the short term, that would create the biggest knee-jerk reaction. In terms of how we'd respond after that, I think the FTSE could possibly respond in response to that weaker pound as we saw after Brexit, whereas maybe if Labour won power, while the pound may stabilise, or the pound could go higher, and some people's views it could go lower in the short to medium term, the FTSE, on the other hand, could be negatively impacted, for example, by some of the Labour policies, such as higher corporate tax rate, etc. So I think all these things has to be taken into consideration. And again, this is just personal opinion. Everyone will have different opinions, and that is why we do get this volatility around these elections. So that's just a little bit of insight into what we can expect on election day. As I said, the polls close at 10 p.m. in the UK time. That's GMT +1. 10 p.m. BST. After that, we should start getting exit polls out, which means we could see that spark of volatility immediately after this. Following that again, that's when we'll start to see actual results. Now, we usually get the first results just before 11 or around 11 from the likes of Sunderland and a couple of other regions, and that tends to give us a little bit of insight into how people have reacted. You'll remember that Sunderland and Newcastle were two of the first places that reported their results in 2016 during the Brexit referendum. Markets responded very aggressively to these results simply because both regions voted differently than people were expecting, and people took that as a sign that the market had positioned themselves very badly. So the volatility could likely start just after 10 from the exit polls, but anything around 11 and then on, it could continue. How long it lasts depends on how it starts to swing. If we start to see signs of a strong Conservative majority, then we may get a good indication of the result by, say, 1 or 2 a.m. UK time. Back in 2015, I think it was around 1 p.m. when we finally got the confirmation, and obviously back in 2010 when we had the coalition government, this required weeks of negotiation, so it was a long time after before we got the actual outcome. But we should have an idea, I think, by around between 1 and 3 a.m. as to who has achieved that victory. Now, that's the brief overview. I hope that covered everything. If you've got any questions, again, please do just ask. We've had one question about what is a hung parliament. A hung parliament is simply when there is no majority. Neither party has the majority which is required to pass legislation, and therefore that's when you tend to see coalitions being formed. In order to get a majority, a party needs 326 seats. The Conservative Party currently has a small majority of only around 15 seats, I think it is, maybe between 5 and 15 seats, and what they're looking to expand on to get more of a majority and make it easier to pass legislation. A hung parliament is when someone can win an election. You could win an election, for example, with 300 seats, but you haven't got that majority of 326, and it's effectively seen as ungovernable, and therefore parties look to join coalitions to get the backing of other MPs in order to ensure that any legislation that they want to pass will pass without opposition, and that's when you start to see deals being made. So it's the hung parliament which I think is the most undesirable outcome of this election, as far as markets are concerned anyway. That's not my, obviously, I'm not here to give my personal political view. I'm sure you'll all be relieved to hear. We'll start with the UK 100, otherwise known as the FTSE 100. This is the UK index, currently trading near all-time highs of around 7600. Now, we have pulled back in recent days, and I do think the election uncertainty has played a part in this. Now, of course, I'm sure other things will have played a part in it as well, such as moving oil markets, because the oil and other commodity markets are a big factor in FTSE 100 companies, but I do think the election uncertainty is certainly playing into this this weakness that we have pulled back now below 7,500. One interesting thing to note about the FTSE 100 is that around 85% of profits generated by FTSE 100 companies are generated abroad. What this simply means is that when these companies are reporting, they report in pounds. A weaker pound tends to make their profits made abroad look better. It tends to flatter them, and that is why, after you see the knee-jerk reaction, that's why after Brexit we started to see the FTSE 100 climb to record highs, despite the fact that the pound languished at its lows, and it was simply because a weaker pound was better for FTSE 100 companies when it came to reporting earnings, those earnings that were being made abroad, where companies were not being impacted by the actual Brexit vote. So the way we have to look at this is two ways. History would suggest that the way markets react is that if you get an undesirable result or an uncertain result, that tends to weigh on sentiment, and when something weighs on sentiment, we tend to get it tends to weigh on markets as well. We saw that when Donald Trump won the election, for example, here early in November, when the result came, this was seen as the undesirable result. What did markets do? They sold off quite heavily. Once they sold off and people started to readjust and we moved on from that initial knee-jerk reaction, markets rallied back, we stabilized, and then we moved on higher. The same you can see on the Brexit vote last June, on Brexit day here. We saw that heavy selling, markets adjusted, they absorbed the information, and all of a sudden we were rallying again. Now, that's not to say the exact same thing will happen here, but given that these are the last two major events, it would at least suggest that an undesirable result or an uncertain result, at least in the initial term, could be, and I stress could be, negative for the index and therefore for the FTSE 100. But should this also have a negative longer-term impact on the pound, then perhaps we will see a return of the FTSE 100 as we saw back here back in June when the Brexit vote happened. But again, that will all depend on other things as well, so it's worth bearing that in mind. Now, the important thing here is important levels. 74 to 7400 is prior support and resistance, so this is going to be the initial barrier to the downside. Should we see a break below here, it would suggest that we've either had some negative news or some very risk-averse trading, and a break below here, in my view, would be quite a bearish signal, potentially opening up a move back towards these kind of levels, because last time we traded below these levels, we were kind of moving between the 7100 lows and the 7400 highs. So a break below 7400 would suggest to me we could be targeting these kind of levels, and that's where we have the 200 and 233 day simple moving average potentially coming in to offer some support. You'll see I've also put a couple of lines on here around 7263 through 7300. Well, these were notable levels of support and resistance here, and therefore there's no reason to suggest why they couldn't offer some form of temporary or some form of permanent support or support and resistance along the way. Should we come down, we could rebound off these levels, for example, or should we break below and come back and retest, we could rebound lower off these levels, for example. As always, this is never a guarantee, but it could give us some insight given how we've traded around those levels previously. Next up, the pound against the US dollar. Now, we've actually seen the pound catching a little bit of a bid today. I think that's been helped a little bit by a weaker US dollar. You can see that once the poll started to close, that was initially seen as weakness for the pound currency. We came back towards these kind of 127.75 levels, and then we've been on a very slow grind higher. There's been no commitment really in this trading. We've just been kind of rising back up below this channel. Each time we connected with the channel, we were coming lower, connected with the channel, becoming lower, and again. And we were hanging below the 61.8 fib for the last few days as well, which was suggesting to me that the markets were still treating this as a little bit of a correction. Again, that could be because they're bearish, but it could also be because they're being a bit cautious and don't want to overcommit to the upside above what looks like a relatively important level, because it was also previous support on the bottom of this channel. Now, today we've been seeing it catch a bit of a bid. The fact that it hasn't taken off back towards these 130s at the moment suggests to me that this is a cautious bid. If we see it break through 130 ahead of the election, then perhaps that would suggest that people are more bullish. But again, I should stress, remember Brexit. Remember June 23rd last year. Here we were right up here above 150. This was Brexit day. People were very confident that we were going to vote to remain. We rallied right into Brexit. We rallied on Brexit day, and then it went against them, and then we fell quite heavily. Now, I'm not saying that we're going to see the kind of moves that we saw on Brexit day, but that doesn't mean we couldn't see a very sharp move lower if people start to if the market starts to show an overconfidence to the upside. I think if we get the uncertain result, then I think we could potentially get quite a sharp move back, even towards these kind of 126s, even potentially further below, because of how big an impact that could play on Brexit talks. So don't be surprised if we see a few big figures being taken out if we get that hung Parliament election vote. That would certainly be, given how we've traded previously, that would certainly suggest that. I think generally the general perception is that a Theresa May and Conservative majority would be more positive, because that would offer certainty and it would suggest that Brexit negotiations get underway, at which point we could see a little bit more upside to come. A strong majority could even be seen as a little bit more bullish for the pound, taking it above these prior highs. And like I say, I think a Jeremy Corbyn victory would be the most uncertain, because there's certainly, in my view, reasons to be both bullish and bearish on the pound. So that will be the most interesting. But given that it's the most unlikely result, then don't be surprised to see that knee-jerk reaction, which is typically negative. Again, nothing is guaranteed, so don't take anything I'm saying here as a guarantee. Nothing is guaranteed here. We're just looking at how things have traded previously and trying to determine what it could potentially mean going forward. Euro against the pound next, and you can see that we've already come off today in the euro pound. Don't take this to be a sign of pound strength, even though we have seen a little bit of pound strength in against the dollar. This has been euro weakness today, and I don't want to delve too much into it, but we did see commentary earlier relating to tomorrow's ECB decision, suggesting the central bank was going to slightly revise lower their inflation outlook, which could have affected their monetary policy and was seen as negative for the euro, and that led the declines that we saw in this currency earlier on. But still, I think we've got an interesting level ahead of the polls tomorrow. We've got around these 86.70s, 86.80s. At the moment, we're holding around these levels. This is prior support resistance, even as low as 86.50s. Prior support and resistance appears to be offering some support in the interim as well. Should we see a break below here, then I think the next interesting level really comes around these 86 levels. Not only is it prior resistance and support, you've also got the 200-day moving average coming into play here. You can see that noted here. So that could offer some support as well. You're also approaching the bottom of this descending trend line, which we traded below for some time. Now, some of you may remember in videos that I've stressed that this looked a little bit bearish, and of course it did. Now, there's obviously other fundamental factors that come into play here. At the moment, it may look as though that this has negated the long-term big head and shoulders that we've had in play here, and as far as I'm concerned, it doesn't yet. Yes, we've broken through the descending trend line, and it looked as though we were heading back towards these 83.50s, but until we see these resistance levels taken out, and until we see new highs being made, then all this is at the moment, if this comes back lower again, all we've got here is a third shoulder, and third, fourth, fifth shoulders can happen on these head and shoulders patterns. Of course, it only becomes bearish once the neckline breaks. This could remain in consolidation in sideways trading, as it has now for since November, so for 7 months, and that could continue for as long as it takes. But a break through these kind of 88 levels, through these prior levels of resistance, would be very bullish for this pair. You may run into some resistance here around these kind of 89s, but ultimately I think a breakthrough here would be a signal that we're heading back towards these highs. That could take days, it could take weeks, it could take months. It may not happen, but it would at least suggest this, and that would rely on pound weakness. Let me remind you, this is euro versus the pound. If the pair moves higher, that's weak for the pound. If it moves lower, that's positive for the pound. Final currency before I take any questions, if there are any, is sterling versus the yen. The yen generally seen as a safe haven currency. So again, should we see that the shock reaction tomorrow and we see that flight for safety, not only could this be bad for the pound, it could be positive for the yen. So do not be surprised if we do get a shock result, if we do get that hung parliament, the undesirable result, don't be surprised if sterling yen is one of the biggest currency pairs to suffer, because you're pitching what's going to be a very weak, or could possibly be a very weak reaction against something that could actually benefit from the reaction because of its safe haven status. And interestingly, it's currently trading around a very interesting level, around 140. What makes this interesting is that not only is 140.40 the 61.8% retracement of this move from the April lows to the May highs, it's also the bottom of the cloud. Now, for those of you who use Ichimoku cloud, quite simply, when the price action is trading above the cloud, it's deemed to be bullish. When it trades below the cloud, it's deemed to be bearish. So when it breaks through the cloud, it's seen as a very bearish signal, and vice versa. Now, there's two things I want to stress here. One, if price action breaks below the cloud, it needs confirmation. That comes from the lagging line. But as the lagging line is already trading beside the cloud as well, a breakthrough 139.50 would give you both a break of the cloud from the price action perspective, but also confirmation at the same time. So I think that would be a very bearish move, but that would require some bad news for the pound. Alternatively, the reason we could be hanging above the cloud right now and seeing some stability forming could be because people are anticipating a Conservative majority, and a Conservative majority could actually spur this higher and see us moving back towards the levels we were at prior to all this election uncertainty for sterling yen. But let me stress again, this would be very bearish in my view for the pound yen. Now, the only caveat I want to put on this is that, as I said earlier, a certain result may be bearish in the shorter term. The knee-jerk reaction may be bearish for the pound, but it could rebound. So if this bounces through here back to 137, 138 and rebounds higher, it's not because this was ignored technically. It's simply because what is perceived to be the negative knee-jerk reaction may be perceived later to be a positive reaction. The case in point being Donald Trump's election. Initially it was negative, then markets rebounded very, very quickly indeed. Brexit was deemed to be negative for the FTSE, and then it rebounded in the next couple of days. That could happen here as well with certain results. I don't think we'd get the negative reaction in terms of a Conservative majority, because like I say, I think that's generally believed to be the more desirable outcome for the markets, and I think that's generally believed to offer stability and certainty. But having seen all these elections over the last few years, I don't think at this point anything will surprise me. Sterling CAD, I've had a request from a young man called Dean. Thank you, Dean. Sterling CAD's trading in much the same way that we're seeing with sterling pound, the sterling dollar, sterling yen. Third time's a charm. The only difference with the price action currently trading around the cloud, we broke above the cloud here into bullish territory. Here we looked as though we were in a very good move. We've come back towards the cloud here, and at the moment we're finding support on the top of the cloud, which would suggest markets are a little bit optimistic. It will be interesting to see if we're also seeing any fib levels being tested. At the moment we've had the 50 tested here. Again, this is a bit ambiguous, so I won't read too much into these fib levels. The fact that the 61.8 lands on the bottom of the cloud, I reckon, is convenient. We have tested it a couple of times, so that would offer support to this fib level. So I will leave that on just for now, but maybe in a brighter color that's doesn't get in the way quite as much, but we have responded nicely, so that would suggest some positive belief here. I think it's also worth considering the Canadian dollar is in the longer term. I still do think it's going to be one of the weaker currencies, and that may be assisting this higher, but I don't think it'll save it if we do get that weak reaction in the pound in the pound tomorrow. The fact that we've seen the moving averages cross above the 55 and 89 cross above the 200 233 day simple moving average, I do think supports this. In fact, the 55 appears to be actually offering some support of its own during these moves as well. And again, a positive reaction for the pound. It wouldn't surprise me if we're trading back around these 78 or even a little bit higher, which is effectively where we were trading prior to all of this election uncertainty. And this comes at a time, of course, when oil is suffering, which tends to be a little bit negative for the Canadian dollar. Okay, I think that's close to 30 minutes now. Unless anyone's got any more questions, I won't waste any more of your time. I want to keep this quite short. Yeah, I think let's call it a day there. I hope you all have a great day tomorrow. I hope all your trading goes well, and hopefully you'll join us for future webinars. And if you've got any feedback, this will be posted to YouTube later, so you're more than welcome to give it. But thanks once again for joining us on this webinar, and I wish you all the best of luck.